rate is greater than the coupon rate. Market rate is greater than the coupon. So this is the case of discount. That's why it is quoted at 96. And what do we mean by 96? It means company received 96, which means company receive a total amount of 96% of 100,000, which is 96,000, right? So this is how they make the amortization table here. All you need to do, you need to record it, and how you are going to record it is just you make the interest payment, interest expense, amortization. So this amortization is added here and decreased from the discount, right? So entry would be on December 31st, interest expense to discount. Okay, so they issued on 31st of August, right? And today is how much? Today's date is 31st of December. So this happened when we don't. Okay, their accounting year ends at 31st of December. So this semi-annually, September, October, November, and December, right? So it means 4 months interest is accrued within the period of 2014. So that's why this is the period 4/6, not the 6/12. Right, guys? We use 4 months, and interest expense is based on Google must accrue the interest rate and bonds payable for 31st of December. So from August 31st to 2014, there are September, October, November, and December, 4 months, right? So this is the interest payment semi-annually, which is to be paid on 28 February 2018. But our accounting period closes on 31st of December. So from this 4320, 4 months, four-month expense belongs to 2014 year. So we record in the 4 months among the 6 months on 2014. So that is the partial period interest amount. That is simple. Similarly, this discount is also 4 months based on 2014. So we record it on. So we call our expense recognition and revenue recognition principle that the expense belongs to that year must be recorded in that year. So that's why we are recording in 2014. So that would be the entry, right? So this is how we calculate the partial entries. That's it. Now the issuing bonds premium, issuing the bonds at premium. So this is the opposite of the issuing the bonds at discount. So in this case, the market interest rate is less than the coupon rate. So we have the illustration here. That is on January 1st, 2014, Southwest Airlines issued 100,000 9% 5-year bond when the market interest rate is 8%. And they receive 100,000 $4,100. So what is the entry on January 1st? They receive cash, higher cash. Sorry guys. Cash to, they receive cash, and their bonds payable commitment is 100,000, right? and premium balance is always credit 4100. This is how you make the entry, right? Fairly simple. Cash, bonds payable to premium and bonds, right? Discount is treated as debit balance. Premium is treated as credit balance, right? Now, you tell me, what is our commitment or what is our liability? Our liability is not 104,100. Our liability is 100,000. So at the end of 5 years, we have to pay 100,000, not 100 and 100,000 4,100. It means gradually the value, bond value decreases. In discount case, the bond value increases. We adjust the discount in the bond value, but here we adjust the premium to decrease the value of the bond. So let's talk about here. So how we are going to report it on balance sheet? This is like this: the bonds payable plus the premium. So bond value is 1041. If it were a discount, we will have a negative here. That would be less than 100,000. So since this is premium, so we add it here, and the value exceeds the face value. So how we are going to make that one? Simple. All the principles are the same, except that the premium is amortized from carrying value. So let's talk about this. So this 4,500 is based on the contractual obligation, which is 100,000. So it's 9% annually. So semi-annually 4.5%. 9% divided by 2. So 8% market rate annually. 8 by 2 is 4%. Right? So interest expense is based on the market value. So this 4164 came from, it is 4% of 104,100. This 4,500 came from 100,000 multiplied by 4.5%, which is 4,500. Right? Here we go. So the difference is called the premium amortized. So this is 336. So 336 is going to be less from 4,100 and also less from the bond carrying value. So this premium amortized, right? And the value is going to be decreased from the preceding book value or preceding value of the bond. Why? Because at the end the value must go back to its liability value, its maturity value, its face value, its principal value, right? So we need to decrease the bond value, the premium bond value, right? In case of discount, the amortized discount is added to the bond value. Whereas in premium, the amortized premium is going to be decreased through carrying value. That's it. Right? So you see here, bond carrying value decreases from 104,100 at the issuance to 100,000 at maturity by the premium amortized. So let's make the entry here about the interest expense and interest payment. So remember that principle holds still, that we record the interest expense and our contractual payment is based on cash. So interest payment is cash. We paid 4,500 and our interest expense is 4,164. So did you notice something? That unlike in bonds payable in discount, the interest expense is less than interest payment, right? Our interest expense is lower, so we record lower interest expense. So interest expense Entry would be interest expense, which is 4164. And how much you pay? You pay 4500. And rest of the thing you adjusted through premium. So decrease in premium is debited. Answer 336. Right? Whereas in discount, we decrease the discount, and decrease in discount would be treated as credit. Right? So this is the opposite one. Premium balance is credit balance. So decrease in premium balance of the bond payable is debited. So if you understand the bonds payable at discount, this is just the opposite of bond payable at premium. Let me just clear the mess here. Right, guys? Interest expense to premium and bonds to cash. That's it. So this is how the interest payments are higher than the interest expense. So gradually interest expense lower down. Why? Because this amortization is going to be added in the interest expense. Why? Because bond value must approaches to its maturity value at the end of 5 years. Right? So this 4100, so this is the difference of 4100 premium must be added, must be decreased from the bond value in order to get to maturity value. So it should be divided into 10 payments, 5 year, 10 payments, but according to the market interest rate, not just straight line method, right? So another thing is that why we go through all this mess to create, to amortize the discount or premium based on market interest rates, like why we bother, and we get different amounts every year, 336, 349, 363, 378. In case of discount, it is it is like this. So in case of discount, it would be it's also uneven number. So every time we have to make a different entry with different amount, right? So the idea is that why not we just retire it on straight line method. So straight line method, it is less precise, used for small companies. It is a less precise way to amortize bond discount or premium. All you need to do, there are 10 payments, so you divide it. So every payment include 410 discount. This is premium, so this 410 would be less from the bond value every time. That's it. If this is the discount 3861, it is divided by 10. Answer would be 386.1. That would be added to the bond, every bond value. But this is not the correct method, right? So the amount of interest expense is the same for each interest period. So method allow if amount differs insignificantly from amount determined by the effective interest rate. So if you see that the market interest rate is 9% and your coupon is 9% and market interest rate is 8.99%. So rather